Big picture, major markets for 2024, here on January 3rd of 2024. Quickly, let's take a look at our disclaimer. It says that all information at askSlim.com is for entertainment and educational purposes only, not to be construed as investment advice. The sole purpose of this website, any oral, written presentation made in any way referring or relating to this website, is to provide information which could be possibly used by a person or entity in discussions with their investment advisor and or investment decision makers. Does not function as a substitute for advice of an investment advisor. Please consult your own financial professionals and, of course, your own plan before making any investment decisions or trading decisions. And you can get our full legal if you go to askSlim.com. All right. A long-awaited video. Have had many emails regarding when this video was going to be coming out, and I have had just hundreds and hundreds of people been signing up just for the purpose of watching this video, because we have now made it a video that was for members only, so it will not show up on social media for several weeks. So people that did sign up or are our premium members get a first look at this. This is a long video. There are 5 sections in here. We're going to look at interest rates, the dollar, metals, energies, and the stock market. It's all monthly charts, and it's meant to give a big picture for 2024. This time we're going to look out further in some of the charts, and I'm going to touch on what our projections were, and then give you what our projections are coming up for 2024. There is a very bold call in here regarding the S&P 500 and gold and their relationships. So you're going to see what I say in there. So for 2023 and 20 review and 2024 is what we're going to look at. For 24, well, I think volatility is going to go up, and I'm going to show you that when we look specifically at the VIX chart. Historic, definitely, because we have historic indebtedness and we've had a historic decline in the money supply. And all of those things are not going to get cured by the election that's coming up. It is not going to matter. And we have historic concentration in the Magnificent 7 stocks, in just a few stocks that have led the indexes up, and expect that there will be a correction in that also. For the stock market, I believe it's a lose-lose-lose situation. It's a lose situation if interest rates go down, because historically, when interest rates go down, to justify that, the stock market goes down. And the biggest declines in interest rates come when there is a big decline in the stock market. So right now we have 6 or 7 cuts by the Fed priced in, and if that's going to be justified, then there's something very bad in the economy out there. If the markets are wrong and interest rates go back up, well, investors are going to be very disappointed. So that's lose number 2. And lose number 3 is that we are at the second highest level of historic valuations in the stock market we have ever seen, with only the previous peak equaling it or more. Previous peak was at around 200% of GDP. I'll show that in charts going forward. And now we close this year at 180% of GDP. So that's the third lose, because it's going to be very difficult for the stock market to make upside ground of any significance in this coming year. Still, I'm not going to tell you that the bull market is over that we're in, or at least this cyclical bull market that we're in, because I'm going to show you I still think there's more time for that to happen. Still, I think it's going to be limited. Let's get into the charts. We're going to start out this special report, the big picture for these markets for 24, by looking at interest rates and treasuries. This seems like the right place to start because we're starting out this year with a lot of anticipation that the Fed will pivot. Actually, it's interesting that we started out last year the same way because interest rates had fallen pretty sharply, and throughout the year there was a constant discussion about the Fed pivoting, and we kept saying that that was very unlikely. And rates did continue to go up. We had thought that rates would be range bound and get nowhere near the high levels that they did, really expecting the top of the range to be 3.8 to 4% in interest rates, which it turned out to be much worse than that. The move up to 5% somewhat inexplicable, except for the fact that the growth rate had moved up pretty high. But then as the hopes for lower interest rates actually came to fruition because of anticipation that there actually was going to be a recession here in 24, then the hopes for the Fed pivot have really built again. So we're going to start out looking at really a blank chart, because for those of you that are brand new looking at this, we really want to look at the canvas that we do our artwork on as we do this analysis. 10-year yields we're looking at. The only study we have on here is our reversal scout, which is very key to cycle analysis when you look at it on a weekly and monthly chart. So this is the monthly look at TNX 10-year yields. And when you look at this, you can pretty much see that yields were in a choppy downtrend for a long period of time. It was actually a 40-year bear market in the yield market, or 40-year bull market in the treasury market, that was interrupted as interest rates moved up from zero, basically, all the way up to 5% that we saw this year. So let's bring in our cycle analysis as I begin to paint over this canvas as we look at and call it the just beautiful artwork that you do when you do cycle analysis, and you can see that right here. So there's a lot on here to discuss, and if you watched last year's big picture, what we were looking at last year was this decline right in here, and that there was a likelihood that that would be met with a further advance, a tick up in interest rates, and with potentially an early decline in interest rates and then moving up. We thought the low would be about 3.2, 3.4%. That's basically where we got to on that low right there. Let's talk about, though, what is on this chart so you understand it. There are three different cycle periods on the chart. And you can see that when we're looking at it here that we have a note that the green zones have rising phases in them that are 6 to 31 months. And this longest phase right over here was about that length. Then it had a correction, but then even extended up more. And usually they're at least a 50% reversal, even in the bearish markets, where yields were falling down, the upside phases were at least 50% recoveries of the downside phases. So that's what that all means. The 63-month cycle has got three minor cycles in it, as you can see right in here. 1, 2, and 3. And there's also an intermediate cycle right here. So the periods where all three cycles are coming down together, that's where these blue timing lines are. And you can see that's where you get pretty sizable declines in the interest rates right there. That's the alignment of the money flows going into the treasury market, which pushes the yields down. These normally align with declines in the stock market. So when the stock market is moving down very sharply, interest rates tend to move down very sharply. When the stock market is moving up, then there is more belief that the economy is strong. Interest rates tend to be firmer during those periods. So we had this long period of an upward move here in interest rates right through here, and that was the anticipation, of course, that the Fed was done, that all of that money that came in from the pandemic, as you could see it labeled right over here, was very stimulative to the market, and the Fed moved up interest rates very sharply during this period right in here. Let's take a look here as we look just at these last several years in here. We're looking back to about 2014-15. and looking at these large harmonics. And I want to look right now where we are. This is very important because we're projecting for the coming year. So you can see in here the minor cycle, and this is the way it's shaped up right over here. And we got some help in here from the reversal scout. When it turns out, it tells us this is the low area, the low timing. Here you could see you got a correction right in here, and that was the low timing as it turned up. And here's your next minor cycle. You can see there. And then you could see that there was another rally. So the intermediate cycle pushing up here, the minor cycle pushing up right over here, and then you got this rally here in interest rates. Now, I want you to note that these yellow periods of risk, generally they come in when the reversal scout turns down. You can see that right over here and right over here. When you get into periods where there is a nesting of the cycles, those are the red area right over there, a nest right over here, a nest right here, and there was a nest right here. This is where we came into the year last year. Right over here, we thought that interest rates would come down a little bit more. In other words, that the treasuries would rally some more. And then we'd get another rebound that would take you up into this area right over here. We did not expect this big move here in interest rates in that 2-month period, but then it came back down into the range we expected. So now what do we expect? We expect that this rising phase right over here is and has ended. We see that because this is the downturn right there in the reversal scout. That says to us that the treasury market is likely to continue down all the way into mid-25. In other words, treasury yields come down into mid-25. You can see right over here that we're looking at the potential for yields bouncing. And we think that there's going to be disappointment in the markets where it turns out that something happens where interest rates pick up again. They realize that the market has overpriced or the amount of interest rates will come down for the year. And you can see in here right at this point where we're looking for a flat. That actually happened right here. And it happened right over here also, with still some months to go on the downside. You can see that. That's what we're expecting right in here. So over the course of maybe the first, we'll call it into the second quarter of the year, we expect a rebound in yields. That rebound in yields should get up between, that's 4.24. This level here is 4.4, let's say it. It's reasonable to expect yields to get up to about 4.4 sometime into the second quarter of the year. As things don't exactly go the way markets would like to see. Of course, there's a huge amount of indebtedness, and that's going to slow the economy down as far as the consumer goes, but at the same time there you've got a huge amount of competition for bonds as the government has huge financings coming up, and that is likely to help push these interest rates back up. We're going to look for that right in here as a rebound is likely. But then we get into this period right over here, end of 24 into mid 25. And this is really where yields could come down very sharply. But again, we're only projecting it down to about 3.2, 3.1%, but potentially down here 3.1% out into 2025. So we are not expecting a giant decline in interest rates. The only way to get that is in a very deep recession and a collapse in stocks, because the only time you get these big declines in yields is when there is a collapse in the stock market. We'll talk about the stock market in a little bit. But right now we can see that we're looking for yields to get up to, let's say, about 4.4% right up over here, a little more, a little less. And then that be the peak for the year, sometime maybe the second quarter, and then be coming down. Now, what's helping me time that is the timing in ZN, the ideal trough. In other words, the time period for a decline in ZNs is Q1 into early Q2 for 2024. That's where I get the timing for this bump that we're likely to get in yields into early 2024. Let's examine that as we look at the /ZN chart. And you can see in here what we're looking at. Now, this is absolutely spectacular chart. When you look at this, you can see that the average cycle lengths are just really, really good. When you look at that, as you can see here, that this cycle was end of the cycle was 15 months. 18 months, 18 months, 17 months, 18 months. There's just beautiful cyclicality in here. You could see the head and shoulders that formed here in the ZNs as interest rates were about to fly, and once it broke down, it projected down here, but it actually fell much lower. So you could see 18 months, 17 months, 17 months. The ideal cycles have about 17 months in length, as we have highlighted right here. And that then illustrates where we are right now. You can see here that this low right over here in October was only 12 months long. Now this is unusual. And then you got this pop right over here. And now we're looking for a decline to finish the cycle, which should take you out to somewhere, let's say, if October was the 12th month, then January is the 15th month. That means that sometime in the next 3, 4, 5 months, probably 3 or 4 months, there will be a decline in here, which then takes you out into the second quarter of 24. That's that pop we're looking for in yields out into the second quarter of 24. That's the alignment in here. Now, this is a very oddly shaped cycle. Some cycles, there's a secondary low that makes the low that doesn't get as low as the first low. The same thing happened in 2008, 2009, and 2021. Let's just take a look there so you can see what I'm talking about. Let's go back to 2008 right over here. Right there, and you could see right in here there was that pop, and then it came down and it finished the cycle. That was on a 16 month. 2009, it popped right over here. It lasted quite a while and then came down and finished the cycle at around the 15 month right over there. So those were a little bit shorter. 2021 is where we're headed to right now. We'll move forward, and you can see here in 21, this is a lot like what we had in here. The amount of this rally right here, right to the peak right there, was about the same as what we've had right over here. And then you could see it just gave way to a much, much sharper low right there. So it could happen that way if there's a big disappointment and interest rates start to fly again on the upside, but we're only looking for 4.4% interest rates. That means it's likely to be a higher trough in here. That would project the downside in here around 108.12 down to a potential here about 107. So 108.12 down to about 107 sometime here by the second quarter. That is what we're looking for interest rates. Again, there is a ton of anticipation right now in the markets that the Fed will be cutting interest rates. There are just tons of cross currents, and as we spoke of, lots of geopolitical things that are going on in this year. And this is likely to be an extremely volatile year, even in interest rates. So we could see a lot of movement in there, and I wouldn't be surprised to see 4.4, 4.5% down to about 3.1% in the yields for the year. So that's it. That's what we're looking for in yields. They will certainly be reflective and influential to the rest of the markets, and be reflective of the what the Fed actually does and what happens geopolitically, and also as far as the overall economy goes. That's the look at interest rates for 24. Next, in this big picture analysis, we're going to look at the dollar and the euro. Of course, we look at both of those because the euro is 57% of the dollar index. So you really have to look at both to get a good handle on the analysis. Let's switch over to the monthly chart, looking here back all the way to the year 2000. And it's always important to me to do a little teaching that I'll do right now. And you can see that the harmonic families that we're looking at in here are the time frames for those are 76 months on the longest ones. The most dominant, the intermediate, is 38 months, and then 19 months on the minor cycle. There are 4 minor cycles that make up the dominant cycle that's in there, and the intermediate is exactly half, as you can see. Let's really look at how those align. It's just absolutely amazing when you look at that. Look at the big decline that occurred right over here as Greenspan killed the dollar in here. And of course, gold went up in a huge way, like 4 times during that period. And here you could see the half cycles right there. Each of those lined up just beautifully. And then you could see the quarter cycles, the way that they come in there. Quarter cycle, that's where they line up here. And when you get into periods where there's nesting, even at the end of the intermediate, the halfway point, you get some bigger declines. And when you get to where all 3 of them are moving down together is where you get usually the biggest declines. That's when the money flows are coming out the most. As you can see in here, this would be the inverse time when the euro would probably be moving up the most during those yellow areas, which are the periods of risk. You can note over here the biggest period of risk that we see is way out over here in 2027. So in the meantime, there are problems here when I look at this chart. Also note the inverted head and shoulders that formed in there and projected up to this target right there, which was just absolutely beautiful. So important, you can go to askSlim.com, go to our workshop page, and watch a free video there. You'll learn more about the analysis that we do. So let's look at where we are right now. The market last year, the dollar market, moved down right in here, and that low was a little bit early, but not too bad. And now the market moved up. Now, a little bit of a lesson on that is why is this decline not still part of this cycle? And the reason for that is the shape of it. The amount of advance was absolutely perfect. The upward turn right up over here in the reversal scout gave you positive momentum, and that really declares that was this rising phase, or these 2 rising phases going on. Now, if that big upward energy from the dominant cycle was still pushing on the upside, it would not have failed here in this resistance. That, by the way, the top of that upside move was around 107.35. We were looking for 108 as the high for the year, so that was pretty good. So now what we're looking for is the euro to give some sense to this analysis, as we'll look at that in a moment. But we're projecting that the euro monthly trough, in other words, the euro is likely to fall into Q3 of this year all the way into Q1 of 25. That means that there's likely to be a rally right in here. However, there's a however. When I look at the intermediate cycles on the weekly chart, they are pointing to a trough or a decline, this decline that it's in right now, to continue out into April. So we're looking for a further decline out over here, get below this low here at 100.6, and then make a bottom in here out in some point in April, and then get an upside move into this resistance area. So we're going to look for a rally maybe into Q3 up to that 103.5, 104 area, outside 104.80 is what that looks like, and then be moving down again. So with the euro monthly trough due in Q3 to Q1, that means that there's a rally over here in Q3 to Q1, down over here into April, up over here. And for this rally to come, it would mean interest rates maybe have to be rising a little bit in there probably to get that. And then there's an issue for how far it will fall right over here into 2025, and then out over here into 2027. Right now, this downward turn right over here on the reversal scout is declaring that this advance is over with, and we are now in declining phases in here. That could only happen, as I said, if this had already turned down. In other words, the dollar is in a lot of trouble for a number of years. Every rally in here through all of this 24, 25, 26 should all be false and likely be moving to the downside in some significant way. So this rally and this decline, breaking the 78.6% this early, assuming this analysis is correct, is the worst we have seen in decades. We have not seen a rally in the dollar that only lasted 3 or 4 months and came down and took out the 78.6%. That is bad. Again, it's probably going to come down more into early part of the year, try to rally, and then come down again. If it breaks the cycle low at 99.578, it's extremely negative. Getting down over here warns under the 78.6 that the left-hand translation has formed. Getting under 99.578 puts the final nail in the coffin, and the dollar would be moving down significantly. Next trough, mid-25, followed by major trough out here in the beginning part of 2027, where this time frame to hold. The dollar looks like it's in a lot of trouble. And there will be rallies. There will be times when interest rates are ticking up, and there will be times when the dollar looks better. But overall, this is really bad. It would really take a rally that takes it back up close to 108 to repair this, what looks like very negative conditions for the dollar. Now, how good are these? How good are these cycles? Take a look right over here, where it bottomed. That was the positive period for the dollar. Look where it bottomed here. Positive for the dollar, positive for the dollar, positive for the dollar, but failed already. That's really, really bad, and that really looks like a lot of trouble right over there. It would have to turn. Back up, get this reversal scalp turned back up for us to believe anything different was occurring in here. Bad conditions. Let's just switch over now and look at the euro, which if we're looking for the decline or stuff to be, the market to be in trouble for the dollar, then we're going to have to be bullish in the euro. EUR/USD is what we're looking at. And you can see we talked about the dollar falling out into 2027. This, you can see, is the rally out into 2027 that we have projected right over there. This looks like this choppy area where the dollar, comes down. This has a little bit more rally. Then the euro comes down, and the dollar does a little bit better right in here as this comes down. So a lot of chop expected here in this year, and then eventually the dollar's coming, and sometime in 25 is really where this upside turn is likely to come in the euro. So that means we're looking for a range in here in the euro currency over this next year. And that range probably is somewhere right out over here. That's about 102. The peak over here is around 113. That's a pretty wide range. You can see that we're expecting a very choppy dollar if the range is going to be this wide in the euro currency. So again, the best time for the euro, the worst time for the dollar, really looks like it comes starting in 2025 right there. And in the meantime, we think we're going to see a lot of chop looking at that. Let's just go back and peek at the dollar one more time here so that you can see, and you can see right there that that period where we expect the dollar to decline starting here in 25 in some significant way out into 27 is where that euro currency looks like it's best. And again, a big choppy period right under here, probably getting down sometime this year under that 100 mark or close to that, and probably getting up here to about, we'll just call it 104 or so is the range. 100 to 104 this year. And if it gets under 99.578, it's really a bad occurrence for the dollar. That's it as we look at the dollar and the euro for 24. Big picture for 24 for gold and silver. Last year, I would say I was a little too conservative on the gold market and maybe a little too optimistic on the silver market. I thought that gold would have kind of a rough time because I thought interest rates were still going to be going up. And I thought that it would stall somewhere under 2,000, and then it would do a little bit better later in the year. Well, that's pretty much what happened, but there was an upside spike that took it up to 2150, but that really didn't last long as gold did end the year right around the 2055 area. So gold did a little better than expected. I thought silver would get up to about 2750. It peaked at 2650. And I was actually quite positive in the silver market, and it ended up to be a bit disappointing. But still not that far off from what we expected in the gold and silver markets. Let's look here at what's coming in the next year. Of course, there's lots of stuff going on geopolitically, and that is supportive for the gold market since there has been the war in Israel and Hamas. The gold market has done better. Not sure that it's that related to it as much as the fact that the U.S. just does not stop creating money because of the massive deficits. And of course, the more money there is, the cheaper money it gets. So in other words, gold's price in relationship to money, to paper money or fiat money, tends to go up because of all of the increase in the amount of money. The gold market against other currencies has done spectacularly better when you look at it compared to the yen, which has been extremely weak. So maybe gold has got catching up to do based on its relationship to the U.S. dollar versus other currencies. That makes sense to me. I'm going to show you this gold market now, and it's going to be a pretty deep analysis, and you'll get a good sense for what I expect going forward, and that is much, much higher prices. Let's take a look here as we look at the monthly chart on gold. So we're looking here back to the year 2000. Very important to be looking at this period right over here where gold was trading down in the 200s. And that was around 2000. And of course, we had the dot-com bust, and Greenspan tried to save the world by lowering interest rates for a very long period of time, keeping them down around 1%. And he literally destroyed the dollar. It fell like 41% during this time period here. And you can see what gold did as it surged from in the 200s up here to nearly 2000. And that was about a 8 to 9 times increase in the price of gold. That was, of course, based on a weak dollar that you can see. I'll show you more about that in the dollar in just a few moments. Now, what we're looking at here are the major harmonic cycles that you could see right in here. This big gold cycle right here made up of a half cycle. So this is a dominant, intermediate, and a minor cycle. And these cycles are very consistent, as you can see. You can see right in here where in 2000, where we had the pandemic response and printing all of that money quickly sent gold up from the 1400s here up into the close to 2100 right there in the pandemic response. So you can see when there are periods of significant fiat money printing, those are periods that gold does very well. So where we are right now is very significant, and I want to show you what that looks like here in the gold market. The market that we're looking at right in here is in this very significant uptrend, and you can see how I have this drawn way up over here. I'm just going to grab this period right in here so you can get a closer look as to where I think we are right now. So this period right over here is just a period of a lot of potential strength. Now, there is a buy period coming up in mid-24, and that is where we think that there's a decline coming here in the gold market. There's a sink there where it syncs up with the intermediate prices, where it likely pulls back over here sometime into that mid-24 period, where it certainly could get down close to that 2000 number again, or maybe a little bit below that. But then right over here is where it really has a very strong potential. We're going to call for 2024 after it makes a low somewhere around 2000 and maybe April, May, or June in that area. And you can see that's these two blue lines are the cycle trough timing period in there in that window. Then we think it'll be moving strongly to the upside, well past 2200, and then to this resistance right over here. That's 2335, 2330, right at that fib extension zone. Then there are these fib extension target zones that are created from the multiple lows in here, and those come up here. This is 2665, and you can see that we're projecting after a move down here, late 25, early 26, all the way up here into later in the decade, 27, maybe 28, where the price comes up over here to 3,000, something like that. Now, see this note right over there in 26 or 27? This is something that people are going to remember me for being very right or very incorrect. And when you see the stock market analysis, you will get a sense for why I think that coming in this next quite a number of years, there are bear markets coming. And I think that the price of gold and the S&P 500 are going to cross at some time in this decade, and I'm going to say probably more like 2027, near 3,200. That is a pretty bold call. S&P 500 and the gold price cross near 3,200. So that would be a very, very bullish projection, of course, for the gold market, and a very bullish, very bearish projection for the stock market, which I think is going to have waves of bear markets over the next decade. So I'll show you that moving forward. So this is the look at the gold market, as you can see right in there, and this period that we're looking at in the gold market, in my opinion, is a period that is extremely positive, though the first few months of 2024 look to me like it will waffle around, as I said, get somewhere around 2,000 or under that level before it then has a surge up near 2,300. So that's a look at this particular monthly chart in gold. I want to give you a little bit that is supportive of that in the gold market. And you'll be able to see right over here this gold chart, which is amazing because I have all of the Fed actions on here, the QEs, the operation twists, the QTs, and the amount of rate cuts and increases that you can see in here. Plus this line right over there that you see is the dollar overlaid on it. So in here where Greenspan was killing the dollar, of course the gold market went up. This was QE1, QE2, Operation Twist, QE3 right there, and you can see you had that big move to the upside, and then the correction in gold that went on over here, and that was as the dollar was in a rebound stage right there. Now this is where the taper tantrum was, and that's kind of what I want to look at in this chart. This is where Yellen was trying to increase rates in here, and there were 3 increases in 2017 and 4 increases in 2018. And you can see gold was just in this kind of basing period, as you can see right in there. And then once they started to cut rates again here in 2019, it was off to the races again in the gold market. You can see that right there. So that was the period where interest rates started to get cut again. And then in 2020, you had these emergency cuts. They took it down to minus 25 basis points, and that's where the gold market was surging again. So here's that period right over here where the markets are pricing in 6 or 7 rate cuts already. And you can see that the gold market has done really well in here. The reversal scout turning up right in there after a brief correction. And here's that minor cycle right there that we're talking about in this potential dip to around 2,000 or a little bit lower right there before it then takes off and makes these much higher prices as we expect. 2023 ended the year with a $34 trillion deficit. There is no end in sight to deficits. The 2024 will end with significantly greater deficits, probably above $36 trillion in deficits, and no end to that massive government spending. It doesn't matter who gets elected. Because if it happens to be President Biden, we know the kind of spending that he is willing to do. And if you look at the potential for a return of President Trump, and those, of course, are the two favorites right now, he showed no sense around reducing deficits, reducing spending, and even pushing for the Fed to push rates down much more. So no real look at the potential for a change in the debasement of the dollar, the spending that is massive and that is very likely to be fueling more upside here in the gold market. So I wanted to show you this chart. I thought it was really very important to look at. Let's just go back to that other gold chart right over here. If I can get that up. Move this out of the way. And here we are back to this gold chart right over there. So this is really the look that we're expecting, moving up into those target zones over the next year. Of course, this is really a video where we're looking at 2024. So I'll just take a quick tight look in here where we're just looking for a pull down in here and then a move up. Probably, I'm going to say easily over 2200, 2300 right over there, or a little bit higher is very reasonable for a price target here in 2024. Let's go to the silver market /SI. And this is very interesting right in here as we look at some comparisons to past times. Let me just blow this out a little bit. And look at the, I'm showing you two major harmonic families right in there. And you can see that there was a mid-cycle dip. If I just duplicate this and bring it to the mid-cycle period, which is right here, you can see how then I'm looking at kind of a half cycle right in there, and where the half cycle right in here was the biggest decline, and the half cycle right in here the biggest decline. Now let's compare this period right here that we're looking at, which is 05 to 2010, where it had that big upside move, and this period right in here. You can see that this decline on that that half cycle right there was steep, as you can see right there, but above these lows, just as it did right over here. Now look at this cycle right there. That was the first quarter cycle after the nesting at the half cycle right there. It is almost identical right in here. And that is showing you that there is a strong likelihood that when this quarter cycle completes the base, as it did right over here, it then takes off. I don't know that it's going to be, this went from 15 to 50 basically, which was, let's say, it tripled during that time frame. I'm being much more conservative here and just saying it's going to follow the ideal projections in here. And then once we get this dip that we're looking at in here, it's going to take off on the upside, but maybe to more realistic levels. Of course, it could be an upside panic, and silver has been held down for a long period of time. Also note here the reversal scout is still negative right over here as it went into this quarter cycle correction. Here it was so strong it actually stayed positive. So this was a slightly stronger period. But again, this is exactly the same spot on these harmonics right here and right here. And that really makes quite a bullish case for the silver market. Let's look at what we're expecting in this coming year. So this is the same thing we were looking for in gold. All metals have ideal sinks or a correction into mid-24. They all look that way, copper, platinum. And we expect in here that it'll come down into this buy zone. It's weak right now. And this is this comes in around let's just say $23 down to about $22, maybe a little lower than $22. And then after that, late April to early May, we're just estimating based on looking at the weekly charts, then taking off with the gold market. I want you to see that we just made that comparison to 2005 to 2010, but all metals are in a period of potential surge to the upside from mid-24 up through mid-25. I've made no secret that I've been accumulating metals, and in the last couple of months I've been buying a lot of the miners, and I'm going to keep doing that, especially in this early part of the year, because I think that there is such a high probability for this to be going strongly to the upside. You see that level right over here? I'm just going to move that out of the way so you can see it. That's 78.6% fib warning right there. That's at around 1930 in the silver market. That's $4 down from here. That's the warning that this very bullish analysis is incorrect. I would like to not see that happen. Because, of course, of my positions and because this analysis, to me, would be ruined if that did happen. So we always want to take a look at what that level would be in the silver market. But I think that period of chop in here in the first quarter and into the second quarter, and then sometime in the second quarter to third quarter, a big blast off on the upside. We're going to project that silver in 2024 is going to get up to the bottom of that fib extension level, which is right around $30 at some point. And I expect that to really come at the in the last half of 24, just as I do in the gold market and all of the markets in the metals markets. Copper should do exceptionally well. Platinum do exceptionally well during that period. I'm not showing that analysis now, but level 4 members can have that by looking in our on our stock grid page for level 4 members, because I'm going to post all of these there, all of the major futures that we look at. So this is that very, very good look at the silver market. You can see, which we're expecting to be moving up into the high 20s and potentially 30 into this year 2024. One more look back at gold so you can see the comparison in here as we look at that gold market, and you can see the same thing, the decline into the second quarter of the year and the surge with all metals with a potential of about 2,300. That, in my opinion, is a conservative estimate into late in the year, high 2200s, 2300. And these are what I consider to be ideal projections right there. They're conservative, really, based on what we're seeing in here. And again, if this gets underneath the 78.6 level, which I will put in there for our members at some point, if it begins to threaten that, that will then warn me that something different is happening. But right now, I don't think that's the case. That is the look at what I consider to be a very bullish metals market for 24, but the real move's coming in the second half of the year. Big picture for 24 for light crude and natural gas. If there's anything we learned in this last year is that there's plenty of oil around. I mean, no matter what OPEC Plus seems to do when they've been cutting back on their production, well, the oil market has not done very well. And come into later part of the year, we've seen some softness as the economies look to be in recession or going into recession in 24. Last year, we thought that the market in oil would come down early and test 70. And that the next rally would likely fail. Well, it actually fell harder early. It got down to about 63. And then we projected that a high would come sometime in Q3 or Q4 and get up to about 96. Actually, it got up to 95 in Q3. So overall, it was not a bad call for us for the year. Natural gas, we were also very close on, and when I show you natural gas, I think you're going to get excited. Let's take a look here as we switch over to the oil market. I always want to highlight the fact that there is amazing cyclicality in these markets, and you can see there is an 18-month average cycle. Let me get my little pointer up right over here that we have designated here. Cycles tend to run, plus or minus a few bars, and so they're not always going to come out exactly. We have the timing lines right in here when the actual cyclical lows were made, and these are where the average or ideal cyclical lows or troughs would be made. And the distance between those lows on average is 18 months, but still you can see beautiful rhythms and cyclicality that is in here. First point that I think is important to make based on where we are right now is that we see that this cycle right in here that occurred in 22 into early 23 was a cycle that started and ended at the same point. Cycle begins and ends at the point of origination. If it was ideal, you would see that it would look like this, and this is about as close to an ideal cycle timing as you will get, though the peak was over here on more on the left side. Usually when you have a left-hand translation like this, you end up having markets that are weaker. And this one took a while to get weak, but you could see came down below the 78.6%. Around mid-cycle is not a good thing. It tells you that the cycle is very likely to fail if it tries to rally and then continue to come down. You can see right over here where the 78.6% broke later in the cycle, but still had a few months where it fell quite sharply right there. So that's important. Look right over here. 78.6% is broken. That says to you here quite early in the cycle that if rallies are to come, they're very likely to fail and then continue to move on the downside. The best case that I can make for oil this year, outside of something that happens very significantly geopolitically, would be that it would come up and fail in this resistance level somewhere between 78 and 81 sometime during the year, and then come down, and you can see where this trough is between these two cycle timing lines. The ideal is somewhere near the end of the year in 24. So that says after trying at some point to come up in here, it's likely to move down again. Very high probability the low for the year will come in somewhere around the 50% fib extension, or this level over here, which is the 61.8% fib extension. So this level right over here is 61. This level right over here is 53.5. 53.5 may be too pessimistic, but we'll take the target of 61 for the low, a range of moving up some point to around 78 to 81, and then moving down here to 61. If anything, I think that that may be an optimistic call. It may end up to be worse than that as a rally in here fails before it gets up into that resistance zone. This one got well up into those resistance zones, as you could see right over there. And this one over here, which actually broke that low, the cycle low period right over there, with a lot of months to go, and then fell very hard, as you can see after that. So this one somewhere in the middle between a very bearish cycle here and a little more positive shape right in here, which is right here, which says oil prices are not likely to do well in 2024. So this is a overall pretty negative look at oil. And here we are at the beginning of the year with lots of geopolitical issues going on, and the Houthis in Yemen trying to shoot at ships in the Red Sea, the Iran sending a warship into the Red Sea, and a lot of other geopolitical wranglings going on. Will Iran get into a hot war with Israel or the U.S.? That's all a question. And what that would mean for oil if they try to block the Straits of Hormuz. These are all things that could happen and could make this picture be more positive. It would take some kind of a significant event, I think, to make the oil market look better than it looks right now, which is actually pretty bad. So oil we're going to call weak for the year. The next future we're going to look at is natural gas, and this one is a very different picture. I want to go out right over here so you could see these big harmonics that we have right in here, and so that you could give a big wow like I do. This is really amazing here when I look at this. Let me move this over a little bit. What I want you to see are these four major harmonic families that occurred back to 2007 that we're looking at here. Now, the key thing that we're looking at, and last year when I looked at this analysis, I drew this in. I said rally and then come back down here towards the end of the year, which is exactly what happened. You can go back and watch that video. Now, I thought that the low would come in somewhere around here, and that actually might still happen. But now look what happens after the lows are made in the beginning of these harmonic families. 262% gain here really came in the first quarter cycle. The cycle's a little off because these cycles are more in line. So the further back you get, the harder it is for them to be exactly in line. So you could see that this was the first half cycle, which actually bottomed right over here, and then the second half cycle, which was a little longer, and then we got into this perfect timing, basically, that we see in here. And you can see that in this case, the peak was made here in the second quarter cycle right over here, 356% up. This one was 240% up in the first quarter cycle, and then it took to the third quarter cycle to make a higher gain, but 240% gain. This one, look at this. I mean, you could see there were 1, 2 minor cycles, 3 minor cycles before it really made the peak. 702% gain right there. That was Russia invading the Ukraine that really pushed it up at that point, and then it went into a collapse because plenty of natural gas out there. Let's take a look at where we are right now. The ideal timing is for the major low sometime in mid-24. It could come sooner, could come later. You can see in here that the blue quarter cycle syncs with the dominant weekly in somewhere around in February of 24 plus or minus. So that could be that sometime in the first quarter is when this low is made based on the weekly pattern. Now that could extend out for a whole nother weekly cycle and then push it out more towards mid 24. We don't know really. What's really interesting is that you can see the reversal scout where it turned up right over here. That is really unusual. You know, it got flat over here and then turned down again at the end of that cycle. But this one right over here is the reversal scout is very positive right over here. And this is essentially saying that there is a lot of strength right now in this market already, even though this is starting to come down. So that says to me that when this is over with, well, what's likely to happen? So we're projecting that, you know, probably sometime in 2024, you're going to get up to here to that 23.6% fib. That's at about 370 right there. That would be a very reasonable spot for it to move up to, just over where these levels were right over there. So that's around this was 370, this is around 385. And then sometime in 2025, you can see that we're projecting up to a 258% gain to this level right over here, which would be around $5. So you say, well, wow, you're saying it's going to move up from somewhere in the 180s as a low or $2 all the way up here to $5 or more? Well, that's not a big call based on everything that I said to you in here about these gains in these beautiful cycle harmonics that you see right in here. It's a conservative call. Why can't it actually go to, you know, $6 or $7? Well, it certainly could based on what we see here. And what I'm saying to you is that there is a major bottom going to be formed in 2024 in the natural gas market. with some potential for some very, very big gains. If you look at only the first quarter cycle here and the first quarter cycle here, this was that 240% gain right over there. Well, this one came from a low of 144 up to 339. So that was about a 250% gain right there. So, you know, calling it up to $3.50 to $4, $3.85 right over here this year, I don't think that's a bold call at all. I think that we're going to see that, and this may be one of the better markets for the year. Well, of course, I'm looking for the same thing in the metals markets if you've already watched that part of this video, and that really is in alignment with what we're looking for as an inflationary scenario that really could be coming in the second half of the year, and that, of course, probably does not bode that well for interest rates, does it? Well, we'll have to see how that all aligns. Natural gas, a major bottom, very likely to be formed before mid-year this year, maybe sooner than that, and then some pretty powerful gains ahead. I think that looks pretty clear. So that's a look at light crude and natural gas for 2024. For those of you that might be watching askSlim videos for the first time, maybe on social media, I want to invite you to go to our website, askSlim.com, and look around. We have many ways that you can engage with us and many of resources that are going to fit into your particular style of analysis and trading. Just want to show you in here that for those of you that are for the first time looking at our site, you can see we have membership options, and workshops is where I really want you to go to at first. You can see the cycle analysis workshop, or the 5 essential building blocks to successful trading. If you go here, there's a free video about cycle analysis, and you get an idea about what we're talking about when we do these videos. You can come down over here and you can see some of the videos and things that we offer. There's a carousel right over here that you can go and click on, and it will take you to different aspects of what we have as far as our offers go. Here's some testimonials here, and here's what I really want to take you to, and that is our membership options right here. Specifically, I want to point you to the day trader, because that's a brand new service that we have. This is amazing. And it's made up of our new impulse monitor, our grid, 15-minute grid that really shows you the conditions of the market and helps you see where support, resistance are, acceleration zones to get those bigger trades. And it has one of my preferred strategies on there, an 8-minute strategy that's running live all of the time. It's only $34.95 a month. Just absolutely amazing. If you're a level 3 or 4 member, you get even a discount on that. So I want you to go in there and take a look. It's just an amazing new offering that we have, and here you can see what our other memberships are. If you're brand new, you want to start on deal, you're going to get some great information on the stock market every single day. So please go to the askSlim.com website, look around, get a good feel for what we do, and if you become a level 2 member, you're going to have access to all of the videos that I produced and the team produced. We have this amazing team, more than 600 videos in our library, still going way back to when I started making them for this site about 8.5 years ago. So just great resources for you as a trader or an investor. Please take a look at it. All right, big picture for the stock market with a little review for 2024. When we came into 2023, I was questioning if the low was made in the market. I had talked about that I thought that there was about a 50-50 chance that we had seen the lows. Though when I looked at the Dow, I said, well, that was almost certain that the low was in for the market, and we were going to have a bull market year in 2023. I wasn't sure whether the low we expected to come in March was going to test the lows that we had seen or not. Turns out that really I was far too pessimistic. I thought that the S&P 500 would, on the outside, get to 4,400, really looking for 4,300 or around 4,360. It was, of course, much stronger than that. The AI stocks drove the NASDAQ and the indexes to the upside, with all-time highs scored by the NASDAQ and the Dow. The S&P 500 missed it by a little bit, and the Russell much, much weaker, as those small caps suffered a lot earlier in the year. So I thought there would be small gains for the year for 2023. There were actually large gains. Take a look at this video just so you can see what I said about the Dow earlier in the year.
On the Dow, this looks to me very clearly like the bear market low is in place. And the rally that we expect to come into the third to fourth quarter of the year is very likely to get it up to all-time highs. So the upside targets for the Dow Jones into that period of this of the first leg on the upside in this bull market would be about 38,000 there to 40,700 on the upside. The probabilities of making it to the all-time high, which is up there near 37,000, that's that level right over there, is extremely high. The probabilities of exceeding that is better than 70%.
So the stock market for 24, the question that I've gotten from tons of people, is it still a secular bear market? Well, people are writing to me, how could it be a bear market if it's making new highs? Well, the truth is it can still be a secular bear market, and I'm going to show you what my projections are in the market, and you will see. So I'll show you some slides in here and some graphics, and you'll get an idea of what I'm looking for and why I think it's still a secular bear market, even though the market has challenged the highs. As I said in the opening of the show, I believe that the stock market still has time on the upside, and based on this analysis, that will not change, but the upside is limited, and I'm going to show you a lot of things in here that I think are going to be supportive of that. Let's take a look here as we look at this slide. So this slide is showing you the Dow Jones Industrial Average from 2007 to 1942, essentially. And in there was a bull market that you can see from that banking crisis in 1907 all the way up through that peak that we know in 1929. And this was a 22-year rising bull market, secular bull market. There were lots of things in here where there were declines, World War II, the Forgotten Depression right in here, 2021, where the government did nothing as the economy went into a depression, and James Grant has a book about that. And then we got into a period where there was a massive expansion, and the market roared up here, gaining 728% off of that 1907 low. So that was 22 years that it moved up. And this is the secular bull market. This is the secular bear market right over here that you can see as the market moved down very, very sharply in here. And there was this huge move to the downside, a 50% gain. That was a pretty short bull in there. When you look at that, only about 6 months, and then this long bear market. So you had a bear market, bear market, bear market, bear market. Yeah, there were 6 bear markets during this period right over here as we got into World War II. So the market really, really was extremely wild during those periods, and you can see that there were a lot of bear markets during that until it finally made its low. 13 years of correction in there with 6 bear markets. You can see, so that's your secular bull and secular bear during that period. 13-year correction after a 22-year rally. Take a look at this now, which is looking at the post-war boom, the World War II and the post-war boom into 1982. And what did we have in here? Well, we had a 24-year bull market. This is your secular bull market in here. And this was really fed by the huge savings that occurred during World War II. People buying all those war bonds and all the soldiers getting paid while they were fighting the war. And sadly, the spouses of those that were receiving money that did not make it back. And all that money spent here in the 50s and all the way up through here. Now, you could see that what happened was that the rally in there was about 929%. It was absolutely massive. That lasted 24 years. And then we got into the corrective period, the secular bear market. I want you to see, in this secular bear market, there were 1, 2, 3, 4, 5 bear markets in there during that period. Actually, you could see here in May of 74 is when I became a trader in the CBOE. So I actually traded this decline, this bull market, and then all of these bull and bear markets right over here. Traded all of those on the floor of the CBOE. And you can see in here, that's what happens during a secular correction. Right in here, and that secular correction was about 16 years. It went to around 1982. Secular bull right in here, secular bear right in here. Now, this right in here, this shape that you see right there, that actually looks a lot like what we've done so far in this bear market that we had into last year, and then the bull market that we have going on right now. And I want you to note that this advance actually made a higher peak than this one did over here. So for those of you that are questioning, can you have a secular bear at a time when you're making higher highs? Well, absolutely, yes, you can. It usually would not make a significant higher high. And this is about 5 or 6% above what this high was over here. So that's important to discuss because I'm going to talk about that in a few minutes when I look at some of the other charts. So that's a look there at the secular bull, secular bear, looking at that period. That was a total of around 40 years, just as the previous one was, as we looked at the 1907 to the 1942 period. So that's secular bear, secular bull, secular bear, right? Okay, so now we'll move on and let's look at where we are right now. Well, what do we have in here? We have a period of 23 years, the rally less than the other ones, 523%. That's from this 22 bottom over here where we had the dot-com bust. And then the market rallying all the way here. Great financial crisis was about the same low as you had over there, a little bit lower. And then this long bullish period in here. 23 years, it's pretty much like we had in the previous two secular bull markets that I'm talking about. And the expectation is 13 to 16 years more with huge ranges. That ends around 2035. And it's likely to have 4 or 5 bear markets more in there. Remember, I showed you the last one where I said 1966, 1968, 1970. That was the same shape that we had back over there. And you can see that the Dow Jones Industrial Average is making a higher high. And, of course, we anticipated it would get to close to 38,000 for that year and for last year. And, well, it got to 37,689. So that was a really nice rebound. We're a very powerful period in here, and I believe still in the secular bear market. So important to see that when you look at that there certainly could be this long period of correction. And when you look at the GDP, well, take a look here. This market cap to GDP in the 2001 peak was 141%. The market cap to GDP in the 2007 peak was 105%. This was crazy as the government overstimulated everything in the everything bubble, which is still continuing, and it got to 197% right over there, and now coming back up to 180% of GDP right there, as the GDP did grow, of course, so that made a little room, but still historic valuation when you look at that. That's why I believe that of that lose that I talked about for the stock market, well, valuations is certainly one of them, and certainly stimulated by the AI craze. So let's look at some more things that I think are important. Is AI lifted the indexes to near historic levels, and a huge concentration is very likely to get corrected. Let's take a look here. This is was put out by Guardian Graphic. You can see all of the sources that this came from down over here, looking at what they call the Super 7 portfolio: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. I would tell you that the AI stocks are different than that. I think that Meta will be one of the giant losers for the stock market next year. Tesla probably also. And there are other stocks in there that I think are much better for AI. And we'll talk about that later in the year. But I think Tesla's going to do poorly. And I think Meta may be one of the worst stocks of the year going forward. Let's take a look. You could see the super portfolio in here. Look at these gains that it had over there. And this is the non-super companies. And you get a very clear look at how they did not do very well. I've showed similar charts when you look at the MAG 7 versus the non-MAG 493 in the S&P 500. It looks very much like this, 70% gains versus 12% gains. When you look at that variation. So that is important, but not all tech stocks did all that well. I just have to show this chart because this is ARK Innovation ETF, and this is where she made her peak over here when you look at that way out in 2022, and you had this bear market, of course, and look how crummy that this ETF did here in 2023, from this point here to this point here. I mean, that was just absolutely awful. And you could see the cycle patterns in here are actually very clear, and now in a rising phase and doing better, getting above that level. So positive, certainly, but not all tech stocks did well. Certainly, it was just really those in AI, and the ARK Innovation did a poor job as far as investing in things that were not in those hot stocks. And this just shows you that, you know, a good example of how in the tech category, the concentration is so much in AI. I thought that was really very, very important to show you. So that's a look at just some background in here for the stock market before we get into this analysis, as we're going to look at the stock market for 2024. I want to start with a chart that I think is very important. I started the show by telling you that I thought that the implied volatility or volatility in all the markets was going to be pretty high. Now, I showed you that I thought that the metals markets were going to move up significantly, and I think money is certainly going to move into there, maybe as it moves out of the stock market. But if money's going to be moving out of the stock market, then that means implied volatilities are going to be going up. So that means I have to prove to you that implied volatilities are likely to be going up. Well, I'm going to do that right now. Look at this magnificent chart. This is the VIX monthly, so it's implied volatilities. Remember that VIX is a reflection of the desire for institutions or big traders to buy insurance. In other words, if they want to buy puts, if they have to insure their positions, then that means that they're going to pay more for puts. So it's a reflection of the price of puts is what it really is, or the demand for puts. When markets go down, when there's a big demand for puts, VIX goes up. I mean, it doesn't get clearer than that. Here you can see, wow, look at these just absolutely beautiful cycle patterns that you see in here. You can see those rhythms as, you know, the markets were very weak in the 2001, 2002 area, and implied volatilities were up. You could see how that went through that, certainly, and through 2007, 2008, these big jumps in implied volatility as the market got weak. And look where we are right over here. These cycles are ending. What does that tell you? There are years of increased implied volatilities ahead. And that first cycle, that first move that you see over here, which, this is a few years, each one of these is a few years, gets you these big jumps in implied volatilities. This one early on got up to 30. This one early on also got up to about 35. This one early on gets up to about 38. This one early on gets up to about 48. This one early on gets up to 39. You can expect 35 to 40 implied volatilities to be coming out in here. That's my first chart that I'm going to show you, which essentially says that we're very likely to see higher implied volatilities for coming years, and that means there's going to be a number of big downside moves in the stock market, and just great visual that you see here about how money flows in and flows out and how that causes demand for puts as volatility goes up. And that is about to start. There's still time, of course. We don't know exactly when that bottom is going to come in implied volatility, but I wouldn't be surprised if it wasn't very soon. So that's an important look at the VIX, which is, I think, something that we have to be very cognizant of, that something is changing. So now let's leave the VIX and let's take a look here as we look at the monthly chart of SPX. Now, this chart is very telling because I've got a lot of projections in there. Remember, I'm expecting that we are in a period of extremely high valuations and coming volatility, and that we are still in a rising period of a cyclical bull market that living in a secular bear market. You can see the cycles in here. I made the bottoms. I have the bottoms highlighted, the troughs a little differently. When 3 cycles are coming down, there are 3 stars. When 2 cycles are coming down, there are 2 stars. And you can see that. Right over here, coming into the middle of this year, there's 1 star because there's only a minor cycle coming down. That would say that there is likely going to be a pullback in here. Now, I talked about interest rates going up, and I talked about that I thought that there was going to be a move in the 10 years to take it back up to about maybe 4.4, 4.5. I have that listed right over here. Your intermediate trough that we're looking at right over here sinks in April, so that would be what we see on the weekly chart. And that's why we're looking for this pullback in here. We think interest rates are going to get a bump to the upside, and the stock market is going to get a pullback right over here. The minor trough that we're looking for looks like it times into this timing range here. And the targets are 44.80 to 42.90. That's this 23.6% right over there. That is a very optimistic call for that to be, and it's more likely that the pullback in here is to about the 42.90 area right there sometime in the second quarter of this year. But, this is just a minor cycle right over here, and that is likely to be followed by more rally. So we're actually looking for the bull market to continue out over here into late 24 and maybe even into 25. Still, we're concerned about valuations, and also the fact that if you look back at that period in from 66 to 75, there was a higher level that the market achieved by about 5 or 6%. This level right over here, which is 5% above the all-time high, would be 190% of GDP. So that's this level right over here, which is about 5,050 right there. That, is a pretty reasonable upside target for late in the year or beginning of next year. You can see in here there are some fib extensions in here. There's a dominant 50 and there's a minor 100 right there. These come in around 5,000. So all of these levels right over here, about 5,000 up to about 5,100, are a very big resistance area, represent 190% of GDP, and would be an all-time high, like 1972, of about 5% over the previous high. I make this as a best case for this cyclical bull market that we have in here, with the highs likely coming towards the end of the year or into 2025, with a likely sharp dip in the middle of the year. So again, we're looking for a decline likely to this area of around 42.80. It could get support at 44.80-ish right there, and then moving up and making a high in the area of around 5,000 sometime late year or the beginning of next year. Then you can see the bear markets right in here, as we think that this intermediate decline in here will be, like we saw in the 1970s, a significant bear market where it comes down pretty significantly. It could be anywhere giving up to 25 to 40%. This target over here, which is the major 38.2% from that wild 666 low, that would be a reasonable target down there. But, now we're talking about 2026 out over here. So that's probably too far to look at, except that if you watch my gold, if you watch my analysis on gold, this is the time frame that I think there's a pretty good chance that gold and the S&P 500 cross at around 3,200. If I'm off on that, then it's way out over here in 2029, 2030 that this will happen, or before that. But that's my big call, a bold call for maybe this whole video, is that the S&P 500 and gold price will cross. I'm guessing it's around 3,200 where that will happen. And some people will write me and say, wow, Slim, that makes sense based on all the analysis. And some people will write me and say I'm nuts. Anyway, wanted to show that to you. But for this year, we're looking only at this time frame right over here. And that says to us a decline, getting support probably at that 38.2% right over here. We'll call it 42.90. And then moving up here and getting near 5,000. The chances of having that move to 5,000 earlier in the year, you can see, is really small when we look at that. It's much better, much more likely that that will happen out over here in Q3 or potentially Q4 right there, or even Q1 of 25 when we look at that. So that's a look at the S&P 500. The NASDAQ is going to be very similar, of course, when we look at it. The NASDAQ did make it to an all-time high. As you can see, there are those same cycle rhythms that we're looking at right there. And the big move up over here that we saw, my projection was to have a rally to this level over here for 2023. You can see that AI made it much different there. Now we're in this period of this minor cycle correction right now, which we think will likely pull back to 15, we'll just call it 15,500 right there. That's not very far. It's only 1,000 points off of that high, with a chance to get over here at 14.5 right there, approximately 14,500, before it then goes up and takes out the highs. If AI craze continues, then that level up there is 19,000. I'm going to say that doesn't happen. I'm going to say it pulls back over here, and then we get back up to these levels around 17.2, or a little bit better than that, making a little higher high than it made over here. This was around 16.9. So taking out the highs sometime late in the year or early next year, and then, of course, this much more bearish period out over here in 25 and 26. So again, a cyclical bull market in what we believe is a secular bear market. People are going to ask me for the Dow, so I want to show this to you. And just a reminder that our level 4 members will get all of these charts posted on our chart grid page. And you can see in here the same cycle rhythms and the same expectation that we have. I just don't have the minor cycle projected in here. I have it right down over here. So again, we're looking for a pullback here in the Dow into an area of about 35.7 down to around 34.3, 35.7 to 34.3. And then after that, moving up again, I would expect the Dow to get up between 39.5 and 40,300 sometime late in the year, or maybe even early in 25, before we get into this downside. So this you can see my projection for this little dip right over here. 35.6 to 34.4 is what I have projected right down over here. So the decline should not last very long, and then be coming back up over there. Projected bear market, you can see, into 2026. Went out a lot further than I normally do. Looking at these, it's important. Let me just go back to the S&P 500 here, because one thing that I wanted to show you, in the past I have given the quarterly cycles, and I've shown a chart with the 28-month cycle in there. There's your 28-month cycle right over there, and you can see where it came down here on the 28-month cycle, came down here on the 28-month cycle, where all of these three were coming down. And this is where that happens out into 29 or 30, where that 28-month cycle comes down again. And that's why I really believe that this is a secular bear market, and there will be a number of very large downside moves out ahead. Each of these minor cycles has the possibility of bringing a sharp downside move as we look out over here into 2030. That is a long look and the big picture of the stock market. So that is it. We're going to wrap it up and say that in this big picture, I've given you a lot. 5 different segments of the market. Of all of the markets, as we looked at the markets in a very long-term view, longer than I normally do. And I am really hoping that you got a ton of value out of this. I know for short-term traders, it's not a ton of value, but for everybody who has money in the markets, or has shifts around money in their retirement accounts, or for longer term holdings, then these longer term perspectives are really good. Remember that our level 1 members can look at our market longer term projections in the apps that we have. And if you need information about how to do that, you can write to matt@askSlim.com. You can write to matt@askSlim.com for anything that you have seen in here. And if there's a question for me, he'll forward it over to me, and I will be able to answer that. I hope that you have a great year here in 24, and that this work is helpful. And I will do an update along the way as necessary as the markets change. That's it. See you soon.